Did you know that nearly 80% of small business sales involve seller financing? If you're looking to buy a business but don't have a ton of cash up front, this might be your best option. But with seller financing, the seller actually becomes the lender, working with you to make the deal happen. In this video, I'll guide you through the entire process of using seller financing to acquire a business, from finding the right opportunity to negotiating a killer deal. Stay till the end for bonus insights on how to maximize your deal and avoid common pitfalls. So let's break down exactly what seller financing is and why it can be such a game changer. In the simplest terms, seller financing is when the business owner, the seller, acts as the bank. Instead of you needing to get a loan from a traditional lender, the seller allows you to pay them back in installments over time, kind of like a mortgage on a house. Now you might be thinking, why would a seller do that? Wouldn't they want all the cash up front? Well, seller financing actually offers some huge advantages for both the buyer and the seller. For buyers, the biggest win is obviously the lower barrier to entry. You need significantly less upfront capital, which can be a lifesaver, especially if you're just starting out in the business world. Plus, getting approved for seller financing is typically much easier than securing a traditional bank loan. Banks can be incredibly strict with their lending criteria, especially for business acquisitions. And here's another huge plus for buyers. Seller financing often comes with more flexible terms. You can potentially negotiate a loan structure that really works for your specific financial situation and business plan. But it's not just buyers who benefit. For sellers, offering financing can make their business way more attractive to potential buyers. By offering financing, sellers open themselves up to a much larger pool of potential buyers. And because it's more attractive, sellers can often command a higher sale price for their business. And let's not forget about the steady stream of income sellers receive through those installment payments. It can be a great way to transition into retirement or fund their next venture. So, as you can see, seller financing can be a win-win situation for both parties involved. Now that you understand the why behind seller financing, let's dive into the how. I'm going to walk you through the entire process step by step so you can feel confident and prepared every step of the way. Step 1. Finding the right business. The first step, of course, is finding a business that actually offers seller financing. Now, not every business will advertise this up front, so you might have to do some digging. Look for businesses with motivated sellers. This could be someone nearing retirement, someone moving out of state, or even someone whose business has seen a dip in revenue, but still has strong fundamentals. Where do you find these businesses? Online business for sale marketplaces like BizBuySell and BizQuest are great places to start. You can often filter your searches to specifically show businesses offering seller financing. Networking within your industry and directly reaching out to business owners you admire can also yield fantastic results. Remember, sometimes the best deals aren't publicly listed. Step 2. Negotiating the deal. Once you've found a business that interests you, it's time to put your negotiation skills to the test. When negotiating a seller financing deal, there are a few key things to keep in mind. First, understand the typical structure of these deals. In most cases, sellers will require a down payment, typically somewhere between 10 to 30% of the purchase price. The remaining balance is then financed over a set period, usually 5 to 7 years, with a predetermined interest rate. Speaking of interest rates, you can expect them to be a bit higher than what you'd get from a bank, usually in the 5 to 8% range. This is understandable, as the seller is taking on more risk by becoming the lender. Now here's where your negotiation skills come in. Always try to negotiate a lower interest rate or a more favorable repayment schedule. Even a small reduction in interest can save you thousands of dollars over the life of the loan. Another pro tip: try to negotiate a deferred first payment period. This gives you some breathing room to get the business up and running under your ownership before those loan payments kick in. But beyond the numbers, make sure you have a rock-solid contract. This document outlines all the crucial details of the deal, including the repayment schedule, interest rates, any collateral agreements, and, very importantly, default provisions. This section outlines what happens if you, the buyer, can't make the payments. And finally, be prepared for the seller to ask for a personal guarantee. This is basically you putting your personal assets on the line to secure the loan. Step 3. Conducting due diligence. Alright, we've found the business, we've negotiated the deal, now comes the really important part, due diligence. This is where you roll up your sleeves and dig deep into the financials of the business. You're not just buying a product, you're buying an entire operation. So, you need to know exactly what you're getting into. This means meticulously going through the business's financial statements, tax returns for the past few years, profit and loss statements, and customer retention trends to see how well they hold on to their customers. You're looking for any red flags, any inconsistencies, anything that seems off. But it's not just about looking at past performance, you also need to assess the business's future cash flow potential. Can it realistically generate enough revenue to cover the loan payments while still remaining profitable? And don't forget to verify any outstanding debts, liabilities, or operational risks that could impact the business's profitability down the line. A little due diligence up front can save you from a world of hurt down the road. Quick tip: don't just rely on numbers on a spreadsheet. Talk to the employees, understand the day-to-day operations, get a feel for the business from the ground up. Step 4. Drafting a seller financing agreement. Once you're satisfied with the due diligence, it's time to get the legal ducks in a row. This is not the time to skimp on legal advice. Hire an experienced attorney who specializes in business transactions to draft a comprehensive seller financing agreement. This legally binding document will outline all the terms we discussed earlier, including the promissory note, which details the loan amount, interest rate, and repayment schedule. It will also include the personal guarantee we talked about, as well as the UCC-1 filing, which is a legal notice that secures the seller's interest in the business's assets. Having a well-drafted agreement protects both you and the seller and ensures a smooth transaction. Bonus insight: think about adding a performance-based clause to the agreement. This means that if the business underperforms for a certain period after you take over, your payments could be reduced. This provides a safety net for you and incentivizes the seller to help you succeed. Step 5. Closing the deal and taking over. This is the final stage where you finalize all the paperwork, transfer ownership, and officially become the new owner of the business. But don't think of this as the finish line. It's actually the starting line of your journey as a business owner. To ensure a seamless transition, negotiate a structured handover period where the seller assists you with day-to-day operations, introduces you to key clients, and shares their valuable experience. This could be anywhere from a few weeks to a few months depending on the complexity of the business. And here's a success tip: have a 90-day action plan in place. This plan should outline your immediate goals and strategies for the first 3 months of ownership. This will help you maintain business stability and keep things running smoothly during the transition. Buying a business is a marathon, not a sprint. Alright, let's bring this all together with a real-world example. Let's say you're interested in buying a small cafe. The owner is ready to retire and has listed the business for $200,000. They're open to seller financing, which is perfect because you don't have the full amount on hand. You negotiate a deal where you put down 20%, which comes out to $40,000. The remaining $160,000 will be financed by the seller at a 6% interest rate over 5 years. This means your monthly loan payments will be around $3,097. Now, before you sign on the dotted line, you do your due diligence. You analyze the cafe's financials, and it's consistently generating a healthy $8,000 per month in revenue. This is great news because it means you can comfortably cover the monthly loan repayments with room to spare for other expenses and, of course, your profit. This is a prime example of how seller financing can make business ownership achievable. You were able to acquire a profitable business with just $40,000 down instead of the full $200,000. Now, I'd be doing you a disservice if I didn't address the potential risks associated with seller financing, because like any financial transaction, there are always two sides to the coin. So, let's discuss some common risks, and more importantly, how to mitigate them. Risk number 1. Overpaying for the business. Just because a business is offering seller financing doesn't automatically mean it's a good deal. You could end up paying way more than the business is actually worth. Solution: get an independent professional valuation. This means hiring a qualified business appraiser to determine the fair market value of the business. This is an absolute must-do to ensure you're not getting ripped off. Risk number 2. Seller defaults on existing business debts. What happens if the seller has hidden debts or outstanding liabilities that they haven't disclosed? These debts could become your responsibility after the sale, putting your investment at risk. Solution: conduct a thorough debt review. This involves requesting a comprehensive list of all the business's debts and liabilities, verifying them with creditors, and ensuring that the seller settles these debts before the closing date. Don't be afraid to ask tough questions and walk away if something doesn't feel right. Risk number 3. Business revenue drops post-purchase due to operational mismanagement. This is a big one. What happens if the business's revenue takes a nosedive after you take over? This could be due to various factors like losing key employees, changes in the market, or simply not being able to replicate the previous owner's success. Solution: negotiate a seller support period. This means the seller agrees to stay on for a predetermined period, typically 3 to 6 months after the sale, to help with the transition. So there you have it. A comprehensive guide to mastering seller financing. We've covered a lot of ground today, from understanding what seller financing is to navigating the intricacies of the process. Remember, seller financing can be an incredible pathway to owning a business, especially if you're looking to minimize your upfront investment. But it's not a magic bullet. It requires careful planning, thorough research, and a healthy dose of caution. Always do your due diligence, negotiate a favorable deal, and protect yourself with a solid contract. Don't be afraid to walk away from a deal if something doesn't feel right. Trust your gut, and remember, there are always other opportunities out there. Now, if you found this video helpful, hit that like button and subscribe to my channel for more insights on business acquisitions, financing strategies, and building wealth. And don't forget to drop your questions in the comments below. Alright guys, that's it for this video. I hope you found it valuable and that you feel more confident about using seller financing to acquire your dream business. If you want to learn more about business acquisitions, real estate investing, or building wealth in general, be sure to check out my other videos. Thanks for watching, and I'll see you in the next one.